All right, guys. Hope you all had a great weekend and a great week last week as well. Interesting times we're living in. Obviously, stay safe and healthy amidst the chaos of COVID and the attacks on the Capitol and stuff like that. Just crazy stuff happening right now. But let's focus on making some money instead of that. So starting off with Riot blockchain. Again, for anyone that missed last week's session, I've been discussing how to trade Bitcoin and Ethereum through equity options. And last week I mentioned it. We were at about 15 or so last week on Sunday session, and we popped up to 28 and change, so almost double in the last week or so. The implied volatility is very, very elevated on Riot, so keep that in mind when you are selecting your strategies. 1 second as well. There we go. So for Riot, for the week ahead, here's the option chain. You can see that the implied volatility is 216%. That is very, very high. That is implying an average daily move of 13.5%. So the current implied volatility is telling us that every single day, Riot blockchain should move 13.5% up or down, right? So looking at the week ahead, for January 15th OPEX, we can see that for Friday's expiration, the current expected move is around $8 in one direction, right? So upside would be 37 or so, downside would be 21 or so, right? Again, if you're betting on upside, you're going to want to use call, actually betting on up or downside doesn't matter. You're going to want to use call spreads or put spreads just because the implied volatility is so high. If you buy a call or a put and it moves against you, you're going to lose your entire position in one shot. So if you're bullish, for example, let's say you want to bet on rising this week again. If Bitcoin rises again this week, you can go ahead and do it, for example, a 30-35 call spread. And in this case, you're risking about $1 of premium here, right? And your maximum profit is a 5-wide spread less $1. Your maximum profit is $4. So you have 4-to-1 risk reward. And your maximum profit is achieved if Riot closes above 35 on Friday, right? If you're bearish on Bitcoin and Riot as well, you can do the opposite of that. And instead, you can buy a put spread. Again, you're going to want to buy probably a bit out of the money to reduce your overall cost and risk. And keep in mind that, as I mentioned before, it's supposed to move about 13.5% per day. So if you're buying, for example, the 25-20 put spread, right, you're risking a bit more here because a lot of people are betting on the put side. You can see that the put to call interest rate here is 0.52, meaning that right now for every single put option that's being purchased, you have about 2 call options being purchased, right? So that's showing that the call side is being skewed right now, and a lot of people are buying calls instead of puts, right? However, so if you're bullish, if you're bearish, you can buy the 25 straight put option and sell the 20 straight put option against it for a put spread. And again, you're risking about $1.90 or so here, a midpoint. And your maximum profit would be 5 wide minus $1.90. So your maximum profit would be about $3.10. So asymmetry of risk on the put side isn't that great. I'd probably just leave it. And if it pulls back, if you want to grab a long position after a pullback, it's not a bad idea. The call side is much more favorable asymmetry of risk. Again, 4-to-1 on the 30-35 call spread for this coming Friday, right? Next, we're going to look at Mara, which is also in blockchain as well. They do crypto mining too, and they have a bunch of patents too, as well around blockchain. So for Mara, they have implied volatility of 184%. That is implying an average daily move of 11.5%. So these are big moving stocks, right? Like every day, expect them to gap up or gap down 10% plus, right? And so looking at the week ahead, we can see that for Mara, the expected move on the week is about $9 or so in one direction, right? So the upside would be around 37-ish, downside would be around 20 or so. And last week, here's a chart. I'll pull the chart right now so you guys can see. Last week, I mentioned it on Sunday, and we were at $10 or so, right? So it's gained 180% in the equity itself in the last 5 trading days, right? I think I mentioned last week the like the 11-15 call spread or something like that. Something small where you had small risk for a large reward. If you played that, you would have made about 500% or something like that. But again, keep in mind that with these massive pops, usually they're followed by either a massive drop or a small drop followed by a second pop. So you got to watch out for the fake out on the downside, and you got to be diligent in removing your risk if you have profits offered to you, right? So looking at Mara now, again in the option chain, we can see that for Friday's OPEX, if you're playing short term again, and again, you can play short term if you want, just be aware that you incur the risk of absolute loss on your position because you only have 5 days till expiration, right? So if you're wrong and it goes against you, you can lose your whole position in one fell swoop, right? That being said, if you want to take some risk and you want some possible large rewards, that's your choice, right? So for example, again, if you're bullish, a very similar play to Riot, you buy the 30, sell the 35 perhaps, right? You're risking $1.10 in premium. Your break even is 30 plus 110. That's 31.10. Your maximum profit is a 5-wide spread less your debit of $1.10. So your maximum profit would be 390 or so. So not too bad overall. You have about 3.5 times reward per unit of risk, right? So not too bad. Again, on the downside, same idea. You can see that the put to call interest is 0.57, so almost the same as with Riot. And you can see that on the downside, if you're betting bearishly, you might want to buy the 25 again and sell the 20 perhaps. And again, I don't really like the bets on the downside here just because the asymmetry of risk isn't that great. Again, like look, you're risking 220 in premium to make 5 minus 220 to make $3.80. It's not really a 280, right? That's your maximum gain is 280, not 380, it's 280. So you're risking 220 or so to make 280. It doesn't really jive with my overall strategy and my liking of asymmetry of risk. I prefer to find 3, 4, 5 to 1 asymmetry of risk where you're risking a small amount of money to make a potentially much larger sum of money, right? So that covers Mara right there. If you are going to go longer term and focus on a thesis of Bitcoin hitting perhaps 100K at some point in the next 6 months, you might want to look at June expiration instead. And then in that case, you might want to look at either a synthetic position on Mara, wherein you're buying a deep in the money call option, for example. Let's say, for example, you want to be long on Mara, you buy the 15 strike call option right now for about $16 or so. That means that you're paying effectively 15 plus 16, $31 per per share, right? And the current price is about 29 or so. So you're paying about $2 of extrinsic value on the position, and you're only paying half the value of the stock, right? So the benefit of that is effectively you get the upside in the stock dollar for dollar, but you get half the downside, right? So just an idea right there. Alternatively, if you want to scalp the high premium right now on Riot or on Mara, you can sell cash secured puts perhaps a month out, for example. The premiums are very rich, right? Like look for example, a month out in February. If you're selling the $10 call option on Mara for February OPEX, you're pulling in about 50 cents or so, or 55 cents almost, right, in premium. That means your maximum risk, if it goes to zero, is $9.45, right? So the margin requirements here are pretty nominal, given that it's a cheaper stock. And basically, you're making 5.5% return on your money in the span of about a month, which isn't bad at all if you're more conservative. And then the caveat being you have to be okay with owning Mara at 10 less 55 cents at 9.45, right? That'd be the caveat. So keep that in mind too. Next up, we're looking at Microstrategy, MSTR, right? They've actually been buying up large positions in Bitcoin the past few months, and they've kind of pivoted from a SaaS business into a Bitcoin company, right? So here's the chart on MSTR. You can see how crazy they've ran recently. In the last 3 months, they've gone from like 162-ish to 550 roughly. So pretty massive run since late October. Here's a line over here. Someone's microphone's open. Let me just check one second. I gotta mute everyone. Mute all. There we go. Sorry about that, guys. So it's ran already. You can see about 240% in the last roughly 3 months or so, right? And again, as Bitcoin keeps on running, expect this to keep running too, because they're holding a lot of assets in Bitcoins right now, right? So looking at the option chain again, same idea as Mara and as Riot. The only problem with this is that trading MicroStrategy, the options are much more expensive because it's a pricier stock. For people with smaller accounts, that's a problem because you're risking a lot more money in each individual trade, right? Mara and Riot are cheaper, so selling cash secured puts, covered calls, synthetic positions, for example, those are much easier to construct with a smaller portfolio. Whereas with MicroStrategy, you're looking at much higher premiums. For example, at the money for Friday, even if you're buying at the money, you're looking at a put price of about $43 per contract and a call price of about $24 per contract. So very, very rich overall. If you're wrong, you lose a lot of money very fast. If you're right, your upside is not as great as with Mara or with Riot, right? So just some ideas there. Obviously, looking at the cash secured puts, way out of the money, for example, there may be some decent premiums to be had, but the collateral required, given the high stock price, is probably too high for most people here. So I would say to kind of stay away from that. Obviously, if you want to trade it though, use call spreads and put spreads to manage risk because the IV is higher than the HV, which means that the implied volatility, which is forward-looking, is much higher than the volatility of the past year, and basically you're paying a premium for that, right? If the IV declines and you see MSTR stagnate for a few days in a row, you'll get IV crushed, right? So just some ideas there. Next, I want to talk about something top of mind, which is Twitter. As on Friday, they were taking a lot of heat for banning certain accounts and censoring people's messages. Obviously, if people are spewing, hate speech and stuff like that, like by all means, ban that stuff or censor it. But I think they're going to hit pretty hard overall with a lot of people leaving the platform, perhaps. So looking at Twitter now, where's my chart? Here it is, TWTR. Let's do a fast analysis on the support and resistance levels. So here's the 1 year chart. You can see over here that support will be around this area, around 45-ish, and resistance will be right around, I guess, all-time highs at 55 area. But on the downside now, I think you're going to see it test the 40 area probably in the next few months. And it could happen even tomorrow, perhaps, right? Who knows? But I'm pretty bearish on Twitter for the next few weeks, as I am on Facebook as well, because Facebook is... they changed the terms of service for WhatsApp. So come, I believe it's February 1st, if I'm not mistaken, you have to agree to allow Facebook to access your WhatsApp data. Otherwise, you can't use the platform at all. So a lot of people are, including myself, are actually going to be leaving WhatsApp and going to alternative platforms. Elon Musk actually suggested on Friday to switch to Signal, which is a application I never heard of prior to that. But keep that in mind as well. So Facebook and Twitter should get hit pretty hard this week. Looking at the option chains on here, I'll pull up the Facebook chart just for a sec so you can see their chart as well. So I mentioned a wedge a few weeks ago that they were trading in, and obviously it looks like it may break to the downside now and perhaps hit as low as like 240. Looking at the option chain now, one sec, let me pull it up. So we'll start with Twitter first. Implied volatility very high, 54%. Historical is 40%. I believe they report earnings in the next few weeks too. So Twitter reports earnings on January 29th week, right? So in a couple of weeks, and Facebook reports earnings on the 27th. So in 2 weeks, they both report basically, right? So keep that in mind as well if you're buying past the week of the 29th expiration date. For Twitter this coming week, the expected move is approximately where is it? Let me see. Let's like close that. What price on Friday? Closing price on Friday was $49.54. So the expected move is about $3 in one direction for this week. I think it's gonna beat that for sure. So you're looking at upside of around 52.50, downside of around 46.50. But I think you're gonna see a move of about $5 or $6 in either direction. So downside probably low 40s. Upside, I don't think you're gonna see upside here this week. So I would kind of stray away from looking at bullish bets. I'd be more inclined for a bearish bet here. And again, the option premiums are pretty cheap, but tomorrow morning, if it gaps down, they'll be much more expensive, right? So that's kind of the issue here. That being said, if you were trading the put side, I may just go with some straight puts and trade that because they're pretty cheap right now. For example, if you bought puts prior to close on Friday, could have gotten for 48 for about 25 cents on the 48 strike, right? So it goes to 25. You're 45. You're making about 275 profit on 25 cents risk, right? So you're making about 11 times your money, right? Not too bad over there. I want to discuss the call side because I'm not very bullish on Twitter this week at all. Facebook, same idea, right? So Facebook has a high IV as well right now, 42%. Historical is 31%. Keep in mind, guys, whenever the IV is greater than the HV, you always want to be cautious in buying straight calls and puts because of the IV crush. So use spreads to mitigate your risk, right? Or sell premium if you want to sell premium. Cash secured puts, covered calls, whatever your flavor is, right? So looking at Facebook for the week ahead, the expected move on them is, let me see, it's 3% in other direction. So 275.80 upside, 259.34 downside. And then the potential move is 4.5% in other direction. Upside 279.57, downside 255.57, right? So looking at Facebook over here, one sec. So upside would be around 280. Right over, one second, let me pull the chart. Sorry, guys. Right over here, 280 is the upside this week. Downside is right over here, right? So pretty wide range of values for a 5-day period. Now that being said, I think you're going to see them decline into Friday. And here's how I would probably play it. Perhaps using a butterfly put spread. 10 wide might not be a bad idea. So for example, if you're betting on a decline down to around 255 area, you might want to look at perhaps buying the 265 puts over here, selling the 255 puts over here, which is right at the lower potential move for the week, and then buying the 245s here. And keep in mind, for a butterfly put spread, you're selling 2 in the middle strike, right? So now you're risking basically $1.80 or so to make a maximum profit of 10 wide, because your maximum profit is from 265 to 255. So 10 wide, your maximum risk is $1.80 midpoint over here. So your upside will be $8.20 on the downside. And then what you want to do is if it popped back up at all whatsoever during the week, you could buy back your middle strikes for pretty much nothing and then ride the put by itself, right, on the 265, right? So that's how I would probably play it, because otherwise the alternative is to just play a straight put spread of, for example, 265, 255, which gives you a debit of about 250 roughly for maximum upside of 750. So 3-to-1 risk reward. If you go out of the money even more and you buy, for example, the 260 put option and sell the 250, in that case, you're incurring a debit of about $1.30 or so. Your maximum upside is 870. So it depends on your thesis overall. If you're bearish or if you're bullish, obviously, then ignore these strategies entirely. That's up to you, obviously, with what you want to do. Do your own research and obviously manage your own risk effectively, because I'm just explaining this stuff just for educational purposes, right, guys? Keep that in mind. Next up, we're talking about some of the wheat stocks last week that popped up with the Senate vote. So we have Canopy Growth that had a nice week, right? They popped up last week from about 25 to 30-ish. You may see some more bullish action on these stocks. So Canopy Growth, there's Aurora Cannabis as well, right? Small little pop there, not too much, obviously. And then you have Tilray as well, right? So a little bit of poppage over here. Again, I'm not a big fan of wheat stocks myself. I don't trade them very often. I know some of you guys do, so I just talk about them for your purposes, that's all. But if you are trading them again, let's look at Tilray, for example, right? So Canopy Growth, for example, right? So again, the implied volatility is 78%. The historical is 67%. Whenever the IV is greater than the HV, look at using spreads, right? Because you incur the risk of IV crush. So looking at for the week ahead, we can see that the expected move is about $2 in one direction, roughly, maybe 250 perhaps. So upside of 32.50, downside of 27.50. If you're playing the bull side over here, you can buy a $30 call option, for example, and sell a $33 call option, for example, right? And in this case, you're risking about 85 cents to make about $2.15, right? So not crazy risk reward overall. And then on the put side, you can do the absolute opposite if you want. For example, buy the 30, sell the 28 perhaps, right? Same idea there. And you probably incur the same risk reward there, because almost the same amount of debit, right? So about 75 cents debit roughly here. Your maximum reward would be about 225 or so, right? So that's wheat stocks right there. Next, we're going to move along to First Solar. So last week, First Solar was actually very interesting because on Friday, here's a chart. I'll pull it up. 1 second. Should grab a little bit of water as well. So you can see that this red candle over here, that was on Tuesday, right? So Monday it popped up to a high of 105. Tuesday morning, Goldman Sachs downgrades them, right before the Senate vote, which is hilarious, right? So they tanked down from 105 down to 91 and change, right? And sure enough, the Dems win the Senate, and the following 3 days in a row pops to 109 high on Friday, right? So a massive recovery, right? Massive recovery. I do think First Solar is a great long-term play, given that the Dems are going to be focusing on clean energy initiatives for the next 4 years. And if you don't want to play First Solar, you can play, the solar ETF TAN or Solar Edge or Jingo Solar, one of those names if you want to. First Solar is an American company though, so I do like them a lot, and I've been following them for a long time. If you want, you can see their all-time chart. They actually were much higher back in roughly 2008. So they're at 325 a share. They rallied up heavily. It actually reminds me a lot of EV stocks right now, where you saw this massive run in solar back in 08. Everyone was super hyped about this. I remember it vividly, and then it kind of cooled down and everything crashed back down again, right? Including First Solar. So this could be the same kind of chart that you see for some of these EV names, right? But focusing on First Solar going forward, I think that they're breaking out of that range. So you can see over here, they actually broke out of this little range right here that they were in over the past few years. And now they may push to around 125, 130 a share in the next few months. So I'm very bullish on them. Looking at their option chain, 1 sec, let me pull this up. Here it is. So if you want to play them for the week ahead, I recommend obviously being cautious, but I would say playing longer term is a smarter way to play this, right? I'm talking like 6 months out, perhaps. So if you're buying, for example, for June, might not be a bad idea. If you want to buy a synthetic position, for example, you can buy the $80 call options. You're paying about $28 premium roughly or so. So your break even is 80 plus 28. So it's 108, right? Current price of the stock is 104. You're paying about $4 of extrinsic value, which means that effectively you're buying a stock or you're buying the equivalent position of owning 100 shares of First Solar stock, which would cost you about 10 grand normally. You're paying only $2,800 for the equivalent position, right? Obviously, do your own research. Make sure that this is an investment that you want to make, and do your own research, obviously, right? But that being said, if you bought that, for example, you can sell premium against it every week on a poor man's covered call. So perhaps you buy this for $29 per contract, and then your break even's 108. So if you sell above 108, you're safe every week, right? So let's say, for example, you want to sell the the 110 strike for Friday, for example, right? You sell that for $1.20 or so, and you're actually reducing your overall debit on your position for June by about $1.20 or so. If it goes over 110, you're making $3 profit or so. So nothing crazy overall risk reward wise, but it's a more conservative strategy for a slower trickle of gains over the next 6 months on a bullish thesis on First Solar, right? For the week ahead, the expected move on First Solar is about $6 in one direction. So upside would be around 110, downside would be around 98 or so. If you're playing upside, I would look at perhaps buying obviously a call spread again, because well, in this case, the IV is actually lower than the HV over here. So you can go naked, but again, on short-term expiration dates, you're better off doing spreads because it mitigates your risk overall. So if you're wrong on your thesis and it goes against you, your loss is like cut in half, for example, right? Because let's say, for example, you're buying the 105 calls by themselves. Well, you're paying about 270 or so in premium. So your break even is 105 plus 270, it's 107.70, right? If it goes to 110 for the week, you make $2.30 profit, right? However, what if you buy this instead and sell the 110 instead, right? In that case, your debit goes down to about $1.50, so almost cutting your risk in half, right? Now your break even is 105 plus 150 or so. so your break even is 106.50, and if it hits 110, you're making 350 profit or 2.33 times your money, right? Not too bad overall. There's also TAN and Solar Edge as well, and I mentioned those two. So here's the chart for TAN. It's been on a massive bull run past year. You can see this right here, just massive, massive run, right? Since March decline. Went from about 21 or so up to 120 now. It's up about 500% in the last few months. So very, very bullish here on TAN. And then you have SEDG as well, right? They've also had a great run in the past year too. They were at about $40 back in March. They're at 356 right now. So very, very bullish on both those stocks too. Not bad ideas at all whatsoever. Next up, we're focusing on the Chinese EVs. So looking at NIO, because NIO had NIO Day yesterday, and they had some interesting information to release. Obviously, I mentioned last week that I was looking for a breakout to new all-time highs if we push there, and we actually closed above the previous all-time highs. So previous all-time highs were 58.81. On Friday, we closed at 59.06. That's very, very bullish. So tomorrow, if we break above that and perhaps break into the 60 range, maybe 60, 64, 65 area, that may create a new price floor around 59 area, right? So the previous resistance of all-time highs would now become support, right? Again, not very strong support because it's only been tested twice, but support nonetheless, right? So looking for the week ahead on NIO, the expected move is 14.3%, so massive, massive move expected. Upside on that is 67.35, downside is 50.49. And then the potential move for the week is 18.9%, right? So the upside on NIO for the week ahead in 5 days could be as high as 70.04 and as low as 47.80, right? So given this information, sorry, pardon?
I'm sorry. How much are the straddles going for?
Straddles right now are very expensive. I'll pull the chain right now so you can see. So NIO. Straddle for Friday is going to cost you $8.60 roughly, right? So the premiums are very expensive, but keep in mind that tomorrow morning, because the IV was inflated due to NIO Day yesterday, right? What'll happen probably in the morning is that IV will crush down and the premiums will also decline as well. So you probably won't see the premiums as high as this tomorrow morning. You might see them, for example, at around $5 or maybe $6, for example, right? That being said, if you are bullish on NIO, you do want to use call spreads for sure, because again, you're paying a very, very rich premium on the implied volatility right now, which contributes to your Vega risk, right? Your implied volatility risk overall, right? And also if you're trading short-term expirations like this week, for example, you're incurring a lot of theta risk too, because each day that you hold the contract, you're losing about 36 cents in premium every single day, right? So again, let's say you're bullish for Friday, right? And you want to trade short-term this week. I don't recommend it because short-term trades are very binary in nature. Either you win big or lose big. It's kind of binary in that regard, right? With options. And understand that risk before you place a trade. But that being said, if you are trading NIO and you're bullish into Friday, for example, you might want to buy, for example, the $60 call option and then sell the $70 call option against it, right? So you have a nice 10 wide call spread. Your debit is about 260 in premium. Your maximum gain would be 740 or so. So you have about 3-to-1 risk reward, which is great. Your maximum profit is realized above $70 come Friday, and your break even is 60 plus $2 and 60 cents or so. So your break even is 62.60, right? Versus if you just play it straight away with just a call option, you're spending 385 or so. And again, if your upside is still $70, you're making less money because you're not pulling the premium in on the $70 call option, right? Obviously, if you want to be a bit more intricate in your strategy, you could do a butterfly call spread as well. So for example, you might want to buy the $60 call option, sell 2 of the $70 call options, and then buy 1 of the $80 call options over here, right? And if you do this, your debit decreases from $2.60 down to $1.75 or so, right? Now your maximum risk is 175. Your maximum reward would be 10 wide minus 175 is 825, and your maximum profit would occur if NIO lands on $70 on Friday at expiration, which is very, very improbable. So you want to target usually 1 to 2x return on your investment. So for example, if it goes to 65, you might want to exit out some of your position there, 68 a bit more, and then cut it all out at 70 or so, right? Break even obviously would be 60 plus 175, 6175. Pretty straightforward there. Obviously, keep monitoring this. If you are going to do a butterfly call spread, be aware that if it breaches the 70 strike area, you can be assigned on your short call options over here, which could pose a problem if you're assigned two contracts because you're only long one contract per position in a butterfly call spread, right? So keep that in mind. That is a key risk of butterfly call spreads and put spreads. Just be aware of that as well, right? If you want to play it longer term though, you may want to look at perhaps going out to, I was looking at it today with some of my students. We were discussing the longer term movements on NEO. Actually, I think we're looking at February, and it was a crazy expected move for February. I think it was like $17 or so in one direction. So yeah, here it is, right? You can see that the expected move for February OPEX, about a month and a half away, is about $17 in one direction. So upside of 77, downside of 43, right? And that should change tomorrow because IB should come down a bit. So you might see this contract down to around 15 or so, or maybe 14. But keep this in mind whenever you're playing a position on a volatile stock, it can turn around very fast as well, right? So that's why you want to use spreads to mitigate your risk. Even if you're wrong, you might lose half the position or the entire position, but you're losing half the amount of money, right? So it's a way of managing your risk more effectively, right? Remember, focusing on slower, steady gains is a way to wealth, not hitting home runs. Amidst a sea of losses. If you lose, for example, 20, 30 trades in a row, and then you hit one home run, you might barely break even or be at a small loss, right? Hitting home runs are going to strike out a lot. So focus more on base hits and focus on base hits every single day or every week or every month, right? Instead of focusing on these massive home runs, which may or may not hit, but have low probability of hitting, right? So obviously put side on NEO, if you are bearish, again, I'm bullish on NEO, but if you are bearish on NEO, then you're looking at perhaps a similar play to what I mentioned, where you might buy, for example, a $55 put and sell the 50 strike put. And in that case, you're risking $1.50 to make $3.50. Again, asymmetry of risk is pretty good over here. Break even is 55 minus 150, which is 53.50. And it's pretty straightforward strategy, right? Bear put spread. I also like selling premium on NEO too, cash secured puts, because each week they actually offer you a lot of premium on each position, right? So if, for example, you want to go out to, maybe not for the week, but for the month, February 19th OPEX, right? You can get $1 almost, or sorry, yeah, $1.10 on the 40 strike put option, which is 40 days expiration. So if you don't mind owning NEO at 40 less $1.10, so 38.90, not a bad idea to do a cash secured put over here. Obviously, you have to be okay owning the stock at 38.90, right? Keep that in mind. And you do require collateral to do a cash secured put as well, right? So just some food for thought. Again, same idea on a synthetic strategy. If you want to go along with NEO and you want to buy for example, a call option that expires perhaps even in 1 year, right? Instead of buying the current equity at $60 roughly per share, for 100 shares, it costs you about $6,000. You could buy the 30 strike call option for about $33 right now. So you're paying roughly half the stock price. You have the same upside, but you have half the downside, right? So not a bad idea overall. The one drawback is you're paying about $3 or so of extrinsic value or premium for volatility and time risk, right? That's all you're paying for, right? But you are paying half the value of the stock for the same upside, pretty much in the equity price, right? So just some more ideas there. Next up, we'll focus on XPEV and the Automotive as well. So you have XPEV over here, right? Here's a chart on the, I want the 1 month chart over here. So we can see that it double bottomed over at 38 roughly on a tweezer bottom right here. It's had a bit of resistance over at 48 area. So again, keep an eye on the 48 area as resistance level, right? And support would be right around 38. If you are trading XPEV, it does have high IV as well, similar to NEO. So looking at the option chain, you can see that for XPEV, 1 second. So we have a expected move for Friday of about $5 in one direction. Upside is 50, downside is roughly 40. Same ideas on trading the volatility. If you're bullish, call spreads. If you're bearish, put spreads. Pretty straightforward, right? For example, if you buy a call spread, you can buy at the money 45 strike, sell the out of the money 50 strike. you're incurring a debit of about $1.65. Your maximum profit is 5 wide minus 165. It's 335, right? Put side, same idea. You simply buy the $45 put option. You sell the $40 put against it. Your debit's about a buck 75 or so. Maximum reward is 325, right? So pretty straightforward stuff, right? Next we have the Automotive LI, right? Same idea on them too. They all trade pretty in step for the most part. One of them will occasionally break out, while the other two will kind of sit back a little bit. And in that case, the past week or so, it's been Neo pumping and XPEV and Lee kind of sitting back. But that being said, here's a chart on Lee over here. Again, similar double bottom overall, or tweezer bottom right here on Lee, about 2650 area. Now you're going to want to see it try and push above 40, I believe it is. Let me put the longer term chart. So yeah, so you want to see it push above this area right here, right? And it has a bit of a ways to go to get there, but that would be your resistance area. Support again is around here. So same idea. If you're bullish, call spreads. If you're bearish, put spreads. Pretty straightforward, right? Now we're going to focus on the big mother Tesla, right? That was my one bad call last week, which I'll take credit for, obviously. But at the same time, I do think it's going to crash longer term because it has been running, on nothing pretty much, right? But let me see the longer term chart. You can see this massive breakout over here to the upside. It hit a high of 884 on Friday, and it closed at 867.50, right? So a little bit of a pullback. I do expect a pretty sharp pullback down to this level again in the next few months, and I think it'll happen pretty abruptly once it does start collapsing. So if you are trading the upside on it, be cautious. If you're buying calls and they're profitable, maybe close them out and then roll to a higher delta, and keep on mitigating your overall risk over and over again, right? Don't keep too much risk on, because again, if it pulls back fast, you can get your face ripped off, right? So yeah, with Tesla, let's just look at the chart. I mean, the option chain again. So for the week ahead, the expected move is 8.2%, upside 952.17, downside 807.87. The potential move is 11.5%. Upside would be 981.22, downside 778.82. So a very wide range of values. Premiums are super rich right now, and you have the IV is way higher than the HV over here. So the risk of IV crush, if you're holding calls or puts just straight away, is very high right now. Very high, right? So again, I would trade it bearishly, probably longer term, a month plus out past earnings, and use spreads. But I actually had a interesting idea this past week, thinking about, instead of shorting Tesla, maybe it's a better idea to go long the conventional automakers like Ford and GM, because again, if the market's pricing in, a huge takeover or paradigm shift in automotive, you got to think that GM and Ford, for example, are going to be some kind of player in that market too, right? They won't just disappear all of a sudden, right? So you might want to go long, perhaps, Ford or GM instead. That might be a better idea than shorting Tesla, right? So betting on legacy auto that may pivot to EV versus trading Tesla on its own, because the premiums are so rich for most people, right? If you're buying a put option at the money on Tesla for a week out, you're paying like $40, right? So for Friday, you're paying, let me see. Yeah, so the 870 strike put option for this coming Friday, you're paying about $3,300 for one contract, right? If you're bearish, you can buy, for example, at the money or go out of the money if you want. Out of the money should pay nicely if and when it crashes, because, for example, if you did a 800 750 put spread, for example, you're risking about $580 or so to make a maximum profit of 50 minus 580. So your maximum profit would be 44.20, right? That's a pretty nice profit and a pretty nice risk reward of about 9-1 on Tesla falling back down and reversing back to its area down there. Because last week the upper expected move was around 750, so it breached the level by about $100, right? And I expect a mean reversion pretty fast. I don't think it's gonna keep running, to $1,000, for example, though obviously it could. Manage your risk well, and obviously trade your own beliefs and theses. And as long as you're managing your risk, that's all that matters, right? I trade my risk, I manage it very well, and if I have a loss, it doesn't matter too much to me, right? Because I'm betting on five or six positions at one time, right? So keep that in mind too. Next up, we have, let me see, Snowflake had a nice pop up this past week. Actually, I mentioned that it'd be a good short around 300 again, and so it actually popped back up last week, right, to a high of $325.72, closed right at 300 on the nose. I expect it to decline further into March when their lockup expiration occurs, right? So they're very overvalued as a company right now. I think that Snowflake, Airbnb, and DoorDash are some of the greatest shorts in the market at this time right now. Here's DoorDash, and here is Airbnb, right? You can see over here. So obviously, with the latter two, you have to wait a few more months for the lockup expiration, whereas Snowflake's lockup expiration occurs in March, and that will be a catalyst event for a huge downside move, right? So Snowflake, I like for the downside. It's my favorite short right now in the market. I think you're going to see it probably hit the lower end of this range right here, 230-ish, and probably dump below even 200 in the next few months. So playing that, you can look at put spreads again because the IV is pretty high on it as well, right? So you can see right around HV, but keep in mind, it's only been trading for a few months now, so this isn't as meaningful as it should be. So looking at downside moves for Snowflake, you have the March expiration, which occurs after lockup expiration, right? And so if you're trading, for example, the out of the money put spreads, which might be a decent way to trade it, you can, for example, buy the 250 put option and sell against it the 200 strike put option, right? In this case, you're risking about $12 premium to make a maximum reward of about $38. So you have about 3-to-1 risk reward roughly, right? So not too bad overall. Your maximum profit occurs below 200. You have 2 months till expiration. You have a earning report in between now and then as well. That's my bearish play overall. Obviously, the one issue with this is that right now, because the March expiration just came out last week, I believe, you can notice that the volume and open interest are very, very low right now. So the spreads are very wide. So you're going to incur more slippage. If you wait a few more weeks, perhaps, and the price holds around 300-ish, you might see these spreads tighten up, at which point the cost of this might go down to about $10 or $8 or so, right? Not a bad trade right there. Otherwise, my bullish bets for the next few weeks are staying Palantir. Palantir has been consolidating for a bit in this little range, and I've been loving them here actually. So I'm pulling the chart right now so you guys can see. Here's the Palantir chart. Again, right now. So I'm actually long it right now, and I want to add more around 20, but it hasn't hit that range yet. But I do think it's going to break to the upside and hit around $30, maybe even 32.50 again, test that all-time high, and then perhaps form a new support area around the highs over here of 27.50-ish, right? I do think that they're a great long-term hold. They remind me a lot of Salesforce in terms of their market positioning right now, and I think that they're going to do great longer term, right? So buying and holding for the long term isn't a bad idea on Palantir, and the premiums are still pretty good overall on monthly OPEX contracts. So if you're selling cash secured puts, or if you're doing covered calls, not a bad idea either. So again, for example, on Palantir, PLTR, if you're doing cash secured puts a month out, you can sell, for example, the 20 strike put options February 19th OPEX, and you're getting about $1.08 or so in premium. So your break even on the trade would be around $18.92. That's the price at which you'd own the stock. And if you're okay owning it there, cash secured puts here is your strategy that you probably want to use. If you own the stock itself, selling covered calls around 30, 35-ish isn't a bad idea. Again, my concern with selling covered calls before a pop occurs is that you might see a pop to 30-ish in the next couple of weeks. And if you sell covered calls too soon, then you're stuck holding your position, and you may have been able to fetch a lot more premium if you were just a bit more patient, right? So I'm waiting until about 28 or so to sell some covered calls in the 33, 34 range. And I'd be happy losing my stock around there at the all-time highs and then buying back in on any kind of pullback again, right? So just an idea right there. On Palantir, for the week ahead on Palantir though, looking at the expected move and potential move, you can see that The expected move is about 7.6%, upside 27.12, downside 23.28, and then the potential move is 11.1%. So upside is 28, downside is 22.40. So if you're trading short term, trading, for example, the call spreads isn't a bad idea because the asymmetry of risk is insane here, right? If, for example, you buy the 26 call option and you sell the 28 call option against it, you're doing a too wide call spread here. You're risking about 45 cents premium to make a maximum return of $1.55, right? So you have 3-to-1 risk reward, and that would be achieved if maximum profit would be achieved if it closed about 28 bucks on Friday, right? So not too bad overall. Break even would be 26.45. If you want to be a bit more conservative, you can go at the money if you want, and then your asymmetry risk diminishes as you go to a lower delta strike, right? Obviously, if you want to go longer term, you may want to look at perhaps buying a contract for a year out, perhaps if you want to trade, a longer term synthetic position. And again, as I mentioned before, on First Solar and what was the last one I mentioned? Also, I mentioned First Solar and Neo. If you want to build your own synthetic position on Palantir, you can buy the $15 call option that expire a year out, and you're paying about $12.50 per contract, right? So your break even is $12.50 plus 15, it's $27.50. You're paying $2.50 above the current stock price. That's your extrinsic value, but you're pretty much paying half the value of the current price of the stock, right? So again, same upside, but half the downside. It's not a bad way to play it at all, right? And then, of course, if you want to use the poor man's covered call strategy, you could buy the 15 strike and your break even is 27.50, and then sell monthly OPEX against it out of the money, right? So anything above 27.50 is gravy. So for example, if you sold the 33 strike premium against that for a month out, you're shaving about $1 off your risk overall. Now your break even is down to 26.50, and your upside for the next month is 33. So your maximum upside would be 650 on risk of 1150, right? So 650 divided by 1150 is a maximum upside in the next month of 56%. Not too shabby at all, right? That's how I would probably play it. What else? Square was breaking out heavily as well last week. I mentioned that, so we'll discuss that for one sec. It's been breaking up pretty nicely, and it's knocking on all-time highs again, right around 247. You may see it push that this week, and then if it pushes that, you're gonna see it probably break much higher. I'm expecting it to push near 300 in the next few months. It's been on a very steep uptrend and very consistent as well. You can see that very heavy uptrend. It'll break a new all-time high, settle down for a couple of months, new all-time high, settle down for a few more months, all-time high, settle down for a few more months, all-time high, so on and so forth. So here you saw a very short cycle overall right here, and they have earnings coming up in. Let me see. Earnings are on the 5th of February, roughly, right? So about 3 weeks or so. And they're growing revs pretty fast. Like right now, the revenue growth is pretty insane. 2018, they did 3.3 billion in revs. 2019, 4.7 billion. Last year, 7.7 billion. So they're growing the revenues very fast. And they're probably one of the heavy hitter players that are going to compete with banking going forward. I think PayPal and Square are pretty strong and well positioned to compete with the likes of Visa, MasterCard, and some of the banks as well. So Square, I think, is a great way to play. And also, it's a play on Bitcoin, too, because they do own $50 million in Bitcoin as well, right? So keep that in mind, too. I think I'll cut it there, maybe, or maybe I'll just look at SPY and the Russell as well. So for the week ahead, the expected move on SPY is 1.5%, upside 387.54, downside 376.12. The potential move is 2% in either direction. So upside is around 390, downside 373.80, right? So again, more volatility expected ahead. I do feel like we're getting a bit frothy up here as well, though. So I am being very cautious in my positioning. And again, using these synthetic positions instead of buying stock on its own is a great way to keep upside in the market while also limiting downside and kind of hoarding cash. Because instead of spending, for example, on Palantir, right? If you're buying the stock for 25 bucks per share for 100 shares, you're putting in $2.5 grand. If you buy the $15 call option for 1 year out, you're paying $1,200 bucks, right? So you have half your money sitting in cash. You have the exact same upside in the stock price using your leap call option, but you have cash sitting there if you want to average down, for example, if you want to buy more, right? You have a lot of optionality with your cash. If you're fully invested and the market crashes, you're sitting on your hands for a while, right? Keep that in mind. Yeah, so that's pretty much it for now. I'm going to cut the feed on the session, but we'll do some Q&A privately, guys, if you want. So stick around. If you haven't subscribed yet, I appreciate that. Hit the like button if you like the video, and share it if you don't mind as well. I'm going to cut the record now. Have a great week, guys, and we'll talk next week as well. So one sec. Let me